Hey, what's up, my friend? So in today's episode, I want to talk about, how do you actually buy high and sell higher, right? Many traders, they know, right? Oh, buy low, sell high. But hey, that's not the only way to trade because you can also buy high and sell higher. And some of the best stock traders I know, they buy high and sell higher. First, let's talk what not to do. So when you're trying to, buy high and sell higher, you don't want to be chasing the markets, right? There is a difference between buying high and selling higher and chasing the markets. When you're chasing the markets, it's usually when the price has made a huge explosive move, right? Where, multiple green candles in a row, so bullish, huge momentum, when it looks like, it's going to the moon. Well, that's where you don't want to be buying, right? Because when you are chasing the markets, there is no logical place for you to set your stop loss. And what you'll do is just set any stop loss at any random level, and when the market does a pullback, you're toast, right? You're out of the trade. So now, how do you buy high and sell higher? So there are two ways to go about it. Number one is you'll do it before the breakout. So let's talk about this. So before the breakout, right, what you want to do is that when the market is at resistance, right, it's near the highs. I know it can be, uncomfortable to pull the trigger, right? But what you're looking for is a build up at resistance. So a build up, right, looks like a tight consolidation. Just imagine, right, a series of candles. They're all very small, very tight, cluttered together. This is what I call a build up. And ideally, you want to have 10 candles or more. So whenever you see a build up at resistance, this is a sign of strength because it's telling you that there are buyers willing to buy at these higher prices. They're willing to buy in front of resistance. And if the price breaks out of the high, there's a good chance that the market will continue higher. And also, don't forget, right, when the price is at resistance, traders will go short. Right, they'll look at the market. Oh, the market is at resistance. Let me go short. And where do the short traders put their stop loss? They'll put it at above the highs of resistance, right? Because that's what textbook says. That's what the courses teach, right? Put your stop loss above the highs of resistance. And when the price breaks out of resistance, what happens? Well, momentum traders will buy the breakout. Traders get stopped out. Their stop loss is actually buy orders, which will also, fuel the buying pressure. And this, leads to a higher probability of a breakout trade. Okay, so the first thing that you want to do when you want to buy high and sell higher is if the price has not break out yet, you want to look for a build up at resistance, right? And then, have a stop order at the highs to buy the breakout. And your stop loss now, right, can just go below the lows of the build up, right? Maybe just 1 ATR below the lows. Okay, so this is the first technique, right, before the price has broken out. Number two, what if the price has broke out and you missed the move, right? You're not in the party, you're too late. What do you do? Well, this is something that I call, right, the first pullback. So whenever the price breaks out, it cannot go up without breathing, right? You just imagine when you sprint 100 meters, 200 meters, right? You have to breathe and pause after a while. And it's the same for trading. After the market makes a huge move, a huge breakout, it needs to pause, it needs to breathe. And this is where you want to pay attention to what I call the first pullback, where the market makes a first pullback right after the breakout. And for those of you who are familiar with chart patterns, it looks something like a bull flag pattern. Okay, and a quick tip for you, right, to help you better time your entry is that you want to overlay the 20 period moving average on your chart, because when the price breaks out, right, it's usually quite far away from the 20 MA. So let the 20 MA catch up with price. And the only way for the 20 MA to catch up with price is where the price starts to consolidate or do a pullback. This is where the 20 MA will start to catch up with price. And sometimes, right, you'll notice that the price starts to respect the 20 MA. It bounces off it and start to head higher. Right, when you notice it, right, when the 20 MA starts to, so-called support the price, right, this is where the price has already made the pullback and you want to get ready to buy the next breakout of the swing high. So this is where you are looking to buy the breakout of the highs, right, after the 20 MA has catch up with the price. And for stop loss, you can just again, right, set your stop loss 1 ATR below either the 20 MA or the most recent swing low. Okay, so that's a second technique to share with you. And finally, right, another one to share is that sometimes, right, the market breaks out and the pullback is very deep. The pullback becomes very deep, exceed the 20 MA. So what now? So what could happen is that the market would start to form a new range, right? You can identify the highs and lows of the range, right? The range might even retest the previous resistance turn support. So let the range form, be patient, right? And what you can do is to look to buy near the lows of the range. You can look for like a false break setup where the price, trigger below the lows of the range and make a sudden strong reversal up higher, back above support. Right, when that happens, right, this is what I call a false break, where the price makes a false breakdown and then closing back into the range. This is where you can look to get long again. Okay, does it make sense? So with that said, that's it, right? I've come towards the end of today's episode. If you've enjoyed it, hit the thumbs up button, subscribe to my YouTube channel, the link is all below, and I will talk to you soon.